everybody. Welcome to Three Clowns. Alex here. It's Thursday, May 7th, episode 24, and today we're looking at what happens when peace breaks out at the exact moment the market decides AI stocks aren't actually infinite, because apparently we can't have both at once.
Morning. I see we've decided reality is a rotating inconvenience again.
Oh man, rotating inconvenience. Tom, I might need that printed on a mug. Good morning, everyone. I'm just happy to be here before the data starts hitting the tape and ruining my mood.
Yesterday I bought one of those easy peel oranges. It fought back like it had something to live for. Took me 5 minutes and I'm pretty sure I lost overall. Starting to think the reverse signal applies to fruit now.
Tom, it's always the things that promise convenience that end up being a full workout. Yesterday, I spent 10 minutes trying to open a resealable bag of coffee that just absolutely refused to acknowledge the perforated line, so I feel your pain.
Here's what's on today's tape. Oil's in free fall on Iran truce noise, which torched energy stocks but lit up cyclicals and sent both gold and silver higher even as risk assets rallied. Metals are basically screaming that real yields just got repriced lower. Earnings beat the drum again, with AMD torching expectations and dragging the whole AI chip complex higher. Japan set the follow on that strength, and we've got U.S. fuel exports hitting record highs as a weird counterweight to crude's collapse. On the regulatory side, the UK's opening fire on PayPal and the card networks. Brussels is eyeing a get-out clause on gas leak rules after industry pressure. Greece just won a major court fight on its old debt, and private credit funds are basically becoming the shadow banking system for UK real estate. Malaysia's holding steady as the energy shock fades. So we've got earnings momentum, geopolitical relief, and some real structural shifts happening underneath. So here's what's actually interesting about today. Underneath the obvious stuff, we got peace-ish headlines out of Iran overnight. Oil got absolutely hammered. The market cheered. Tech rallied hard on AMD's numbers, all very normal. But then gold and silver ripped right alongside equities, which that doesn't usually happen, and it's telling you something nobody's talking about yet. When commodities and stocks go up together like that, it's not a risk-on move. It's a the dollar is getting softer move. So what we're actually seeing is less markets are happy about peace and more the dollar's losing grip, because maybe inflation doesn't crack as hard as people thought. Oil's down because of the geopolitical relief. The oil ETF got pummeled, down 7% yesterday, but precious metals are up because the real rate environment just shifted. And that's a completely different trade than what people think they're playing. We're not celebrating lower risk, we're pricing in a stickier inflation picture underneath what looks like good news.
Yeah, AMD basically did the thing everyone needed it to do. Proved this isn't just Nvidia selling shovels into a gold rush that may or may not exist. Data center up, guidance up, customers actually spending money. That's real CapEx, not vibes. But the reason the QQQs gets to be up 2% on that is the 10-year quietly stepping down to 435. That's the whole trick. These AI names are long-duration assets. You're paying today for cash flows way out there, so when yields drop, the present value magically looks smarter. Same earnings, different math. Suddenly everyone's a genius again. Pre-market tells you the truth though. AMD down a bit, NQ barely green. That's digestion, not doubt. The only thing I'm not fully buying, if this is really a softer dollar, stickier inflation setup like you're saying, why are yields falling at the same time instead of backing up? That's the part that doesn't quite line up.
Tom, the math feels broken because we're looking at two different fires. Yields are backing off to 435 because oil just fell off a cliff. That 7% drop in the oil ETF is basically a get-out-of-jail-free card that gives the Fed cover to stop swinging their sledgehammer for 5 minutes. But look at silver, up over 6% yesterday. That's not a relief trade. That's the market realizing that if the Fed pauses just because energy is cheap, they're letting the rest of the inflation basement keep smoldering. So tech rallies because the math on future earnings looks better with lower yields, while gold tells you the dollar is losing grip because we aren't actually putting the fire out, we're just ignoring the smoke.
So the real question today isn't whether the rally holds, it's whether the market finally figures out that oil being cheap and inflation being sticky are actually the same problem, wearing different masks, and we're about to find out what that costs. Let's get into the tape. Okay, so we're looking at oil this morning, and it's actually a really clean example of headline risk meeting fundamentals that don't quite add up. Yesterday morning, Axios reported that Washington is basically done negotiating an MOU with Iran, one page, and if that goes through, it opens the Strait of Hormuz back up, kills the risk premium that's been baked into crude for months. Oil futures dropped 8% on the headline, the oil ETF down over 7, the energy ETF down 4, and here's the thing. We're opening this morning another 2.5% lower in the oil ETF before anything else is even changed. But the FT also ran a piece yesterday about U.S. fuel exports hitting record levels, which is supposed to be a bullish story for energy, and nobody's asking why we're treating an unsigned, not yet ratified memo like it's already law when we're simultaneously exporting crude at historic rates. That's the tension we're working with.
The speed is the thing. 8% on something that does not exist yet. Do you think that is real conviction or just positioning unwinding because nobody actually wanted to be long oil at 80 plus?
It's both. There was a geopolitical premium that was always fragile, and the speed tells you CTAs and trend followers got stopped out at the same level simultaneously, which just amplifies the move. But here's what nobody's saying out loud. The deal still has to survive Iran's internal politics. White House itself says their leadership is divided. So we're selling off 8% on something that has maybe a 50-50 chance of actually happening, and even then it wouldn't take effect for months. Ray, what does this do to the inflation picture if it actually sticks?
Well, it gives the Fed a massive gift for headline CPI, but it's honestly a bit of a trap. Cheap gas is basically a tax cut for the consumer, so they take those savings and spend it on services, which is exactly what keeps core inflation sticky. Does this actually help the Fed, Alex, or does it just make the core numbers look even worse by comparison when they don't budge?
It helps the Fed politically, but not mechanically. Core stays sticky because cheaper gas just gets spent on services, and that's not the Fed's problem to solve with rates. The real gift is they get to say inflation's falling without actually having done the work themselves. Anyway, AMD absolutely crushed after hours yesterday. Data center revenue up, they raised guidance, stock up nearly 19%, Nvidia riding along. And here's what's interesting. The market treated this like proof that AI CapEx is finally turning into actual operating profit, which technically it is. But the QQs are up 2+% on a single earnings beat. And I keep coming back to the same question Tom asked about oil. Is that real conviction about the earnings power of these chips, or is it just relief that the AI trade hasn't completely fallen apart, mixed with crowded positioning that happens to unwind the other way this time?
It's the second supplier thing. Nvidia being dominant is a story. AMD putting up real data center numbers means it's a market. The uncomfortable bit is margins. Nvidia prints absurd ones because they're the only game in town. The second AMD scales, pricing power stops being theoretical. So yeah, it confirms demand. It also quietly caps how good this can ever be.
Yeah, so Nvidia's margin story is basically the expiration date on the entire AI supply chain trade. The second there's real competition, the economics completely change. Okay, but here's what's weird about yesterday. We got this big rotation into cyclicals. Industrials up 2.6, small caps up 1.5 on the back of cheaper oil. Makes sense on the surface. But utilities actually dropped 1.4 and financials barely moved at 0.5%. If this was really about yields falling and margin expansion across the board, defensives should have caught a bid. They always do when yields compress. Instead, we're seeing what looks like pure positioning unwind out of safety and into cyclicals on geopolitical relief. Ray, does this feel like a real regime shift or just a one-day exhale?
It's an exhale, for sure. The market is treating an unsigned memo like a done deal and pricing in permanent margin relief for industrials before the ink is even dry. but the second oil snaps back, and it will if Tehran blinks. That rotation is going to look like a massive head fake because the fundamental relief just isn't real yet.
Right, and the second Tehran changes its mind, we're all going to remember why we don't make portfolio calls on unsigned pieces of paper. But here's the thing that actually matters. Gold up 3%, silver up 6.4%, and they held overnight while equities are ripping. That's not the safe haven unwind you'd expect in a real risk-on move. That's the market pricing in both geopolitical risk goes away, and the Fed still can't hike as aggressively as it thought, which means real rates stay depressed. Silver's doing double duty. Precious metals bid from the Truce, plus industrial demand from data center build-out and electrification, so it's catching a bid from two directions at once. Tom, what does it tell you that gold and silver are up on a day when people are rotating out of defensives?
It's not risk-on, it's cash is the worst asset in the room. Gold doesn't go up with stocks unless people think the unit everything's priced in is quietly getting worse. That's not disinflation, that's debasement with better marketing.
Japan's opening higher on the back of U.S. tech and the geopolitical relief global risk appetite spilling over, and that's real. But here's the part that actually matters. U.S. fuel exports just hit a record, which means refiners are making money hand over fist even as crude is collapsing. The margin is just shifting from upstream to downstream, so the energy complex isn't under as much pressure as the headline tells you. And then there's the UK opening an antitrust probe into PayPal, MasterCard, and Visa on the fee side. Feels like a data point, but it's actually the beginning of a much bigger conversation about who captures value in digital payments when the entire structure is about to change. We'll get into the weeds on that in Nerd Corner. For now, Ray, let's go deeper on the macro setup that's holding all of this together. Over to Footnotes. Ray, walk us through what the market's actually trying to tell us when oil's in the tank, but gold won't quit. Because that's usually noise, except it's not today.
It's so weirdly perfect. Like watching a magic trick where everyone's looking at the left hand, the oil price, while the right hand, gold, is actually doing the work. Look, usually oil and gold move together because they're both inflation stuff. But yesterday was a total decoupling. Oil down 7% on those Iran truce rumors. The oil ETF just fell off a cliff. Normally that makes people think inflation is dead. Lower gas, lower CPI. But look at what the 10-year yield did. It dropped 6 basis points down to 4.35. And that is where the math gets fun. Gold doesn't really care about the price of a gallon of gas. It cares about the real yield. That's the nominal yield, minus what the market expects inflation to be. If nominal yields drop because the market thinks the Fed is going to use cheap oil as an excuse to pivot, but actual core inflation, the stuff in the basement like rents and services, stays hot, then your real return is actually shrinking. Gold is literally screaming that the Fed is about to make a mistake. It's saying, go ahead, believe the headline, but the basement is still on fire. And silver. Silver is up 6% because it's got the double whammy, precious metal hedge, plus it's being shoved into every data center and transformer being built for the AI boom. So you get this tax cut for the consumer because gas is cheaper, which means they spend even more on services, which keeps core inflation high, while the Fed thinks they've won because the headline number looks better. It's a trap. Gold sees the trap. The dollar gets weaker because people bet on a dovish Fed, and that pours more fuel on the metals. And you can see that conviction in pre-market right now. The gold ETF is holding on to those gains, up almost another full percent this morning. That's the signal that this isn't just a nervous twitch. It's a sustained shift in how people are positioning for a Fed that might be getting boxed in. And even with crude dumping on the Iran news, look at the refiners. U.S. fuel exports just hit a record high. It's this weird bifurcation where the upstream guys are getting whacked by the headlines, but the downstream demand is so relentless that the actual energy complex is way healthier than the price of a barrel suggests.
So play that out for me. If the Fed takes the bait and leans dovish because gas prices behave, is that actually bullish for the AI names? Or is it one of those things where you get the multiple expansion first, and then 3 months later you realize you just reflated the exact inflation problem that forces them to come back and break it properly?
Tom, you're describing the ultimate sugar rush. Short term, if the Fed takes the bait on lower oil, it's rocket fuel for AI names because lower yields create immediate multiple expansion. Everyone's willing to pay more for future growth. But it's a total head fake because core services is still incredibly sticky. So easing just because gas is cheap is like pouring kerosene on a house fire that's already burning in the basement. Eventually, they'll have to pull out the sledgehammer to fix the core inflation they ignored. And that tool doesn't care if you're a tech giant or a dry cleaner. It just breaks the entire liquidity pipe for everyone.
Ray, real quick, the Greece thing. They just won this UK High Court case on the 2012 restructuring, and my read is basically lawyers sharing in a room somewhere. But does this ruling create a precedent that other countries can point to if they ever need to restructure? Or is it just one court saying one thing about ancient history and everyone moves on? Because if it's the latter, I don't care. But if there's a domino risk buried in here, that matters for how much faith people have in owning emerging market debt right now.
Alex, it's mostly the lawyers winning on billable hours. But there's a nasty little lesson in the fine print. What's wild about the Greece ruling is the court basically said that when Greece retrofitted those collective action clauses, it was a valid exercise of sovereign power. It means if you own debt issued under local law, the government can essentially change the locks on the house while you're still inside, and the courts will hand them the keys. It's not a domino for the market today, but it's a reminder that local law debt is a pinky promise that can be revoked if the politics get ugly. And speaking of shifting risks, look at the UK property market, where private debt funds are now outmuscling the big banks as the biggest lenders. We used to worry about banks falling over if real estate tanked, but now that risk is sitting in opaque private funds that don't have to market every day. It feels safer because there's no bank run, but we've lost the early warning system. The risk is held by people who are paid to pretend it isn't there. Finally, Malaysia holding rates even as oil cools off is the perfect wait-and-see move. They know that if they cut just because the energy shock is fading, the ringgit gets smoked and every imported component for their electronics industry gets 20% more expensive. It's the ultimate proof that headline inflation is a liar. They're staying high because the moment they blink, the currency market punishes them for being soft.
Ray, this EU methane thing. Brussels suddenly flexible the second industry and the US lean on them. Is that a one-off carve-out because energy security is still fragile? Or are we watching the green transition get quietly repriced in real time? Like targets are aspirational until winter shows up and everyone remembers how heating works.
Tom, it's absolutely a repricing of reality. When the wind was at their backs and gas was cheap, the EU could afford to be the world's moral arbiter on methane emissions. But the moment you're leaning on US LNG to keep the lights on, and your industrial base is screaming about costs, those rigid green targets start looking like a luxury you can't afford. It's the same pattern everywhere. Security is the new sustainability. If you push the regulations too hard right now, you just deindustrialize your own backyard while importing that same carbon footprint from somewhere that cares even less. It's not that they've given up on the transition. It's that they've realized they can't legislate their way out of a supply-side shortage without breaking the economy first.
So the through line here is that when you're short on energy and long on ambition, you end up choosing, and right now everyone's choosing survival over virtue, which is exactly what the market needs to price in. Tom, you've got the real story today on what's actually happening in the chip wars and the payments infrastructure underneath it all. Nerd Corner is yours. Tom, you've got two things. AMD's earnings and what it says about the whole AI chip pecking order, and then the UK poking around in payments fees. Take us through both.
All right. AMD first because that's the actual signal under all the noise. They didn't just beat, they beat in the one line that matters. Data center. Up big, guide up again, and crucially, it's not we signed some MOUs with hyperscalers who may or may not actually spend. The revenue is already there. Racks are being installed, silicon is being paid for, depreciation clocks have started. This is CapEx turning into operating reality. For 2 years we've been trading promises. We're going to spend. We're planning clusters. AMD just showed you the receipts. Now, the second supplier thing is where it gets uncomfortable. Nvidia's whole situation relies on being the only adult in the room. You get CUDA lock-in, ecosystem gravity, and then you charge whatever you want. That's how you end up with margins that look like a software company wearing a hardware costume. AMD showing up at scale breaks that. Not kills it, breaks it. Because the moment a hyperscaler can say, I'll take 70% Nvidia, 30% AMD, you've just introduced price discovery. AMD just has to be good enough. And that caps Nvidia's ability to keep pushing price per GPU into the stratosphere every quarter. And the market knows this, it just doesn't care yet. You saw it, AMD up 18%, Nvidia up 6% in sympathy. That's not how competition is supposed to work. That's like announcing Pepsi exists and Coke rallies. But the reason it works for now is the pie is still expanding faster than the slices are fighting. Total AI spend is exploding, so both can win simultaneously. The tension comes later when growth normalizes and margins become the battlefield. That's when second supplier stops being a nice story and starts being a pricing problem. Now, the .com comparison. I get why people are saying it. Semis vertical, everyone crowding into the same names, price action that feels like it's being chased rather than owned. Last time we saw charts like this, it ended poorly. But here's the difference. AMD just printed operating income tied to that demand. Real revenue, real margins, right now. In 1999, it was we have clicks. Today it's we have $10 billion of silicon deployed and growing. That doesn't mean the multiples make sense. It just means this isn't fiction. Nvidia at 35 times earnings, which is fine, if it goes exactly right, forever. And this is where rates sneak in. The 10-year at 435 is your permission slip. Lower discount rate, higher present value of all those future AI cash flows. Same earnings, different multiple. If that yield backs up meaningfully, you don't need bad earnings to get downside. You just need gravity to come back into the equation. So AMD confirmed two things at once. The demand is absolutely real. This is a live CapEx cycle. And the best business in the world just got its first credible competitor at scale. Those two things can coexist for a while. They just don't coexist forever.
Tom, that Pepsi exists, and Coke rallies line is the perfect summary of the current mood. But here's what I'm trying to square. You mentioned the 10-year at 435 being the permission slip for these valuations. How sensitive is this AI build-out actually to the cost of money? If yields back up to 5% because inflation stays sticky, does the whole CapEx cycle freeze, or is this so deeply baked into long-term contracts and structural must-haves that the hyperscalers keep writing massive checks regardless of what the Fed is doing? Is this a cycle that can be broken by a spreadsheet?
Yeah, it splits cleanly. The stuff that's already been signed. The power deals, the long-term capacity, even some of these multi-year chip commitments. That's not getting turned off because the 10-year goes to 5. Microsoft didn't go back into 3 Mile Island so they could check rates quarterly. That's baseload. That's a floor. It's effectively pre-committed infrastructure spend, where rates bite is the next decision. The next data center, the next cluster. Do we pull forward another 10 billion or wait 2 quarters conversation? That's a spreadsheet. Higher discount rate, longer payback. Suddenly the internal hurdle rate matters again. so the floor is locked in by long-duration power and capacity bets. But the ceiling is still a duration trade wearing an AI costume.
Right, so the committed stuff keeps humming regardless of the 10-year. But the next tranche, the incremental decision on whether to build data center number 12 or wait, that's where rates matter. So for someone holding Nvidia or AMD right now, the floor is real. You get some protection from those long-duration bets that are already locked in. But the ceiling doesn't protect you at all. If yields back up materially, it's not like the committed stuff saves the stock. You're trading a company whose growth rate is lower than you thought. You're basically betting the committed capex is big enough to matter as a valuation floor. And I genuinely don't know if it is. Tom, take us into the payments thing.
All right, payments. Because this one sounds boring right up until you realize it's a tax on basically every dollar that moves. Interchange is the core of it. Every time you tap your card, the merchant pays a fee. Call it 2 to 3% in the US, a bit lower in regulated markets. That fee gets split, the issuing bank takes the biggest cut. Visa and MasterCard take a smaller piece for running the network. And you, the consumer, think it's free because you get points. The points are just your own money coming back wearing a little hat. Now, why does this exist? Because someone has to front the credit and take the fraud risk. When you buy something on a credit card, the merchant gets paid immediately. The bank waits for you to pay them back, and if it all goes wrong, fraud, chargebacks, the system eats it. Interchange is the price of that plumbing working instantly, globally, with very low failure rates. It's actually an incredible system. It's also very, very profitable. Where it gets convenient is the rules. Visa and MasterCard don't just run rails. They set the terms of how you're allowed to use them. One of those terms is, you can't easily route around them to a cheaper option at the point of sale. Merchants are sitting there going, I have a cheaper pipe right there and I'm not allowed to use it. That's what the UK is poking at. And then PayPal, similar structure. If you accept PayPal, you don't get to pick the cheat flows versus the expensive ones. You take the bundle. It's like subscribing to a cable package because you wanted one channel and accidentally buying 12 cooking networks. So the allegation is, the networks and wallets have used rules to keep pricing power intact, even as the underlying technology would allow more competition. What happens if regulators win? This is where it matters. Force routing choice, and you introduce price competition into something that's been remarkably stable for decades. Interchange doesn't collapse overnight, but it compresses. Basis points matter here. 10, 20, 30 basis points is billions of dollars moving from banks and networks back to merchants. Unbundling is the bigger risk. If each piece has to justify its own take rate, they stop being one blended fee and start being line items. And line items get negotiated down. Zoom out, this isn't a UK one-off. The EU capped interchange years ago. Australia did the same. The US has been circling it. The direction of travel is clear. Regulators see a toll booth that got too comfortable. And here's the uncomfortable bit for investors. Visa and MasterCard are some of the highest quality businesses in the market. Incredible margins, global networks, asset light. They look like they should compound forever. They also rely on a fee structure that only works if nobody seriously challenges it. Pristine fundamentals, political long-tail risk. Those show up all at once.
Tom, points are just your own money wearing a little hat is going to live in my head. Here's my footnote for the Fed, though. If regulators actually succeed in crushing interchange fees globally, does that show up in the inflation data? Because the pitch is always lower cost for consumers. But in practice, does the price of milk actually drop 2 cents? Or does the grocery chain just pocket the difference? In the markets where they've already capped this, the EU, Australia, did the savings reach the person at the register, or did the middle of the sandwich just get thicker?
It mostly stayed in the middle. The EU capped interchange in 2015. Studies show large retailers kept the bulk of it with only a small, patchy pass-through to prices. So you flattened the fee and made Tesco happier. Milk didn't suddenly get cheaper.
So regulators get to feel like they won, merchants get some breathing room, and consumers basically don't notice anything changed, except the card network is slightly less profitable. Which means if the UK or EU actually moves here, Visa and MasterCard take a haircut. But the real risk is if it accelerates across multiple jurisdictions at once, and people realize the margin compression is bigger than the multiple assumed. All right, calls. Tom, you're up first. All right, let's see how yesterday went. Ray nailed the 10-year, called it closing below 438, and it landed at 435.6, so the oil collapse gave him the win. Tom and I both whiffed. I said the Russell ETF closes up less than 0.5%, and it ripped 1.5 on trade truce news, so that one stung. Tom had AMD closing below $400, and it held at 421 on earnings, so both of us got schooled. Scoreboards got me and Tom tied at 7 right, 14 wrong, which is to say we're both basically guessing. And Ray's now at 4 right, 15 wrong. He was the only one who actually showed up yesterday. Which tells you everything you need to know. Let's see if we can actually pick one today.
AMD closes red, gives back about 5% from the open, as yesterday's buyers remember what 18% in a day usually means. The move yesterday wasn't just good earnings. It was positioning unwind plus every AI tourist piling in at once, and those flows don't come back on day 2. The 10-year backing off helps, but it's not enough to justify that multiple expanding again 24 hours later. I'm wrong if it holds above 420 and just doesn't sell at all, in which case it's not a trade, it's a religion.
Tom calling a stock a religion is the most Wednesday night in a basement thing I've heard all week. But honestly, 18% in a single session is basically a mass hallucination, so he might be onto something. I'm looking at the gold ETF. It's catching a real bid here as the 10-year yield keeps sliding, so I'm calling for the gold ETF to finish up at least 1% by the close today. See, with oil getting hammered, the market is starting to price in a much faster drop in inflation, which makes the real return on cash look shaky and sends people running to gold as the ultimate hedge. I'm wrong if the 10-year yield spikes back above 4.4% before the lunch break, which would mean someone found a big pile of inflation hiding under a rug yesterday and didn't tell us.
Gold up because everything else broke is always a comforting thesis. You're basically long we have no idea what's going on, which has been a great trade.
Ray's got the yield collapse thesis and Tom's writing momentum fade. Both reasonable, but they're looking at different time horizons. Yesterday's oil drop was real, but the oil ETF's already down nearly 3% pre-market, which means the inflation story might be priced in faster than Ray thinks. The 10-year's only down 6 basis points from open, not some dramatic capitulation. I'm going to fade both the gold momentum and the AMD washout. They're too obvious. The S&P ETF closed up 1.4 yesterday on actual breadth, and the S&P futures are barely moving this morning despite all this chop. That suggests the market's not panicking or euphoric, just waiting. I'm calling the S&P ETF to close flat to slightly up, somewhere between 732 and 735. I'm wrong if we get a real yield spike above 4.4 or another massive single-name blow-up that spooks the entire tape into selling.
Alex, calling the S&P waiting while the entire energy complex is melting down is like saying a house is quiet while the foundation is literally shifting underneath it. I still think that yield move is going to force a bigger rotation than a flat close suggests, but we'll see if the boring trade wins out today. Let's see who the market decides to humiliate at the open. See you guys tomorrow.
3 grown men confidently predicting coin flips, and somehow the coin still feels insulted. See you tomorrow?
Thanks for hanging with us on 3 Clowns. Subscribe wherever you get your podcasts, and head to 3clowns.co for all the links and calls we butchered today. We'll be back tomorrow to do it all over again.